It wasn't subprime mortgages. It wasn't Lehman Brothers. It wasn't even the deregulation of derivatives. It was the inescapable gravity of a debt cycle reaching its mathematical limit. Most observers agree that 2008 was a warning shot, a tremor before the earthquake. The structural imbalances that caused that crash were never resolved. They were merely transferred. Private debt became public debt. Corporate leverage became sovereign liability. The risk didn't disappear. It migrated upward to the balance sheets of nations. Now the bill is coming due. The pattern is unmistakable. The arithmetic is merciless. History shows us exactly what happens when an empire reaches the limits of its credit. It does not matter if the technology changes. It does not matter if the politicians claim this time is different. The laws of economics are as rigid as the laws of physics. When liabilities exceed the capacity to pay, default is the only outcome. The only choice is the form that default takes. It can be an honest default, where debts are wiped clean and creditors take a loss. Or it can be a dishonest default, where the currency is debased to pay the debts in worthless paper. The incentive structure always favors the latter. The politician seeks to delay the pain. The central banker seeks to provide liquidity. The population demands the preservation of their nominal wealth. Under these constraints, the rational move is always to print, to dilute, to extend and pretend. But this creates a feedback loop. More debt requires more liquidity. More liquidity creates inflation. Inflation forces interest rates higher. Higher rates crush the budget, so they print more to suppress the rates, and the cycle accelerates. It spirals until the currency itself breaks. This is not a theory. It is a historical constant. We have seen this movie before. We know the plot. We know the ending. We can look at the Roman Empire. We can look at the Weimar Republic. We can look at the British Empire. The specific dates change. The mechanism remains the same. Consider the Roman Empire under Nero and the subsequent crisis of the 3rd century. At its peak, Rome was the master of the known world, yet its fiscal obligations became unsustainable. The cost of maintaining a standing army to guard the frontiers, combined with the demand for free grain to pacify the mob in Rome, exceeded the tax base. The political incentive was clear. Do not raise taxes on the powerful, and do not cut benefits to the dangerous poor. Instead, Nero began the process of debasement. He reduced the silver purity of the denarius from 100% to roughly 90%. It seemed like a clever shortcut. It allowed the state to spend money it did not have. But once the precedent was set, his successors accelerated the process. By the mid-3rd century, the silver content of the currency had collapsed to less than 5%. The denarius was no longer money. It was a copper coin washed in a thin layer of silver that rubbed off in a soldier's hand. Prices skyrocketed. Trust in commerce evaporated. The complex trade networks that fed the empire disintegrated because merchants refused to accept the state's worthless tokens. The human cost was total. A soldier, once the backbone of the empire, found that his pay could no longer feed his family. He demanded payment in goods, in land, or in gold, rejecting the very state he served. The middle class was wiped out, their savings in currency rendered valueless, leaving only those who owned productive land to survive the transition to a feudal economy. Just like the Roman experience, the Weimar Republic in Germany offers a terrifying lesson in the speed of monetary collapse. Between 1914 and 1923, Germany faced a wall of sovereign debt from World War I and the crushing burden of reparations. The industrial output of the nation had been decimated. The tax revenue was insufficient. The government faced a binary choice: impose austerity and risk immediate revolution, or print money to pay the bills. The incentives dictated the outcome. The Reichsbank, under the leadership of Rudolf Havenstein, chose to monetize the debt. Initially, the inflation was manageable, a slow erosion that many attributed to corporate greed or foreign speculation. But the mathematics of exponential growth are deceptive. By 1923, the dam broke. The government began printing money not just to pay debts, but to function on a daily basis. The currency moved from a store of value to a hot potato. Workers demanded to be paid twice a day. so they could rush to the shops before prices rose again. A simple cup of coffee might cost 5,000 marks at 10 a.m. and 8,000 marks by noon. The tragedy was most acute for the prudent savers, the elderly pensioner, who had spent a lifetime saving enough marks to retire in comfort, found that his entire life savings could not buy a single loaf of bread. The social contract fractured completely. Speculators who borrowed heavily to buy hard assets became billionaires, while the honest middle class was destitute. This economic violence paved the way for radical political extremism. Just like Weimar Germany, the decline of the British Empire in the 20th century shows us how a global reserve currency dies. In 1914, the British pound sterling was the undisputed king of global finance. It was as good as gold. But to world wars and the creation of a massive welfare state drained the national treasury. Britain moved from being the world's creditor to the world's debtor. For decades, British policymakers tried to maintain the illusion of strength. They relied on the sterling area, a bloc of countries forced to hold pounds, to prop up demand for their debt. But the fundamentals had deteriorated. The debt-to-GDP ratio was suffocating, and the industrial base was uncompetitive. The market eventually forced a reckoning. Confidence eroded slowly, then all at once. There were devaluations in 1931, 1949, and 1967. Each time, the government promised it would not happen, right up until the moment it did. The final humiliation came in 1976, when the United Kingdom, once the master of the globe, was forced to go to the International Monetary Fund for a bailout. The human element here was the London clerk or the shopkeeper, watching the purchasing power of their wages dissolve against the US dollar, realizing that the empire's prestige could not pay the heating bill. The standard of living stagnated, and the country entered a period of discontent and strife that lasted until the structural reforms of the 1980s. The pattern repeats in 7 distinct stages. Stage 1 is sound money. The country has a currency backed by hard assets or strict fiscal discipline. Prosperity is real, based on production and savings. Stage 2 is layering. The government begins to build a welfare or warfare state that exceeds its tax revenue. They introduce paper claims on money, expanding the supply slightly beyond the reserves. Stage 3 is expansion. The government and the financial sector increase the money supply aggressively to fund wars, social programs, or infrastructure. GDP rises, but it is an illusion fueled by credit. Stage 4 is inflation. The excess money supply begins to chase a finite amount of goods and services. Prices rise. The government blames speculators, supply chains, or foreign actors. But the cause is monetary debasement. Stage 5 is denial. The authorities insist that inflation is transitory or manageable. They manipulate the data, changing how inflation is calculated to hide the true extent of the damage. Stage 6 is the flight to real assets. The population realizes the currency is losing value. Permanently, smart capital flees into gold, land, commodities, and foreign currencies. The velocity of money accelerates as no one wants to hold the cash. Stage 7 is collapse and reset. The currency is either destroyed completely or revalued against a hard asset or a new currency. Debts are wiped out or restructured, and wealth is transferred from creditors to debtors. Just like the British Empire in the 1970s, current data suggest we are deep into the later stages of this cycle. The United States and much of the developed world have debt-to-GDP ratios that exceed the levels seen at the end of World War II. But unlike the 1940s, we are not demographics that are young and growing, we are aging. The entitlement obligations for pensions and health care are unfunded, liabilities that dwarf the official national debt. Interest payments on federal debt are now threatening to exceed the defense budget. The trap is set. If the Federal Reserve raises rates to fight inflation, they risk bankrupting the government and crashing the banking system. If they lower rates to save the government, they risk unleashing a second wave of inflation that could union-core expectations permanently. There is a counter-argument. Many economists argue that modern central banks have tools that Rome and Weimar did not. They point to the ability to coordinate globally, to use swap lines, and to manage expectations through forward guidance. They argue that because the US dollar is the world reserve currency, there is nowhere else for capital to go, giving the system infinite runway. But this ignores the incentive structure and the arithmetic. The exorbitant privilege of a reserve currency is not a law of nature, it is a matter of trust. When that trust is abused through excessive issuance, the world seeks alternatives. We are already seeing central banks record gold purchases at the highest levels in decades. We are seeing bilateral trade agreements settling in local currencies. The demand for the debt is waning just as the supply is exploding. No amount of technical tooling can fix a solvency problem. With more liquidity, the endgame approaches in one of three ways. First is controlled decline. This is the path of financial repression. Interest rates are kept artificially below the rate of inflation for a decade or more. This slowly transfers wealth from savers to the state, liquidating the real value of the debt. It is a slow, grinding impoverishment of the middle class, similar to the post-WWII period in the UK and US, where bondholders lost value in real terms year after year. Second is chaotic collapse. This occurs if the bond market revolts, yields spike uncontrollably, the currency crashes, and the economy grinds to a halt. This is the Weimar or Zimbabwe scenario. It creates a vacuum of power, and usually leads to severe social unrest and authoritarian responses. Third is reset and restructure. This is the 1940 for Bretton Woods moment. The major powers gather to establish a new monetary system, likely pegging currencies to a basket of commodities or a new digital unit. In this scenario, existing debts are often redenominated, and the value of paper wealth is significantly altered. The only variable is timing and pain. Subscribe to this channel to understand the signals as they emerge. Education is your primary defense. Resilience is your only hedge. Pay attention to the data, not the rhetoric.